Coming up on Market to Market. The Environmental Protection Agency releases its renewable fuels production requirements for 2014. Prior to EPA's announcement, however, the Associated Press releases a scathing report on ethanol. And renewable fuels advocates fire back with a few criticisms of their own. Those stories and market analysis with Jamie Kawaki. Next.
This is the Friday, November 15 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Responding to the Arab oil embargo of 1973, President Richard Nixon vowed to make the United States energy independent within 7 years. Unfortunately, 40 years have passed since Nixon's pledge, and America is still waiting. Over the years, motorists have grown accustomed to the pain at the pump, but nothing like they would experience during the first years of the new millennium. The national average price for a gallon of unleaded gasoline tripled from a low of 98 cents per gallon in 1999 to a then unheard of high exceeding $3 per gallon in 2005. Believing that renewable fuels could help wean America from its dependence on foreign oil, lawmakers included ethanol production mandates in the 2005 energy bill. This week, though, the Associated Press released a series of reports that were highly critical of ethanol production. Renewable fuels advocates condemned the AP reports and fired back with a few criticisms of their own. John Nichols examined the claims on both sides of the issue and filed this report.
Washington responded to soaring gasoline prices by including a renewable fuel standard, or RFS, in the 2005 energy bill. The RFS established an ethanol production mandate requiring 4 billion gallons of the renewable fuel to be blended with gasoline in 2006.
We are the United States of America.
1 year later, then Senator Barack Obama declared his candidacy for president. And like George W. Bush, the Illinois Democrat praised homegrown alternative fuels like ethanol and called on Congress to approve a new, higher renewable fuel standard. And that's exactly what lawmakers did, increasing the ethanol blending mandate to 36 billion gallons annually by 2022. Since corn is the dominant feedstock of U.S. ethanol, the expansion also fueled a classic bull market. Corn futures prices, which had fallen below $2 in 2005, soared to a then record high of $7.54 per bushel during the summer of 2008. But almost as quickly as it began, the renewable fuels boom encountered strident opposition from critics who blamed ethanol for everything from higher food prices to deforestation in developing nations. And in recent days, ethanol supporters defended themselves again in the court of public opinion. The Associated Press published a series of stories this week, in print and in video, criticizing the Obama administration's support of ethanol and the renewable fuel standard. Ethanol advocacy groups said the AP simply ignored the facts in favor of its predetermined narrative, and characterized the reports as lazy journalism that was littered with misinformation and inaccuracies. AP's senior managing editor stood behind the reporting, saying it was the result of months of work that included interviews of experts and people on all sides of the public policy debate about this energy resource.
Most people don't think about what goes into their tanks other than the price. But every pump of gas comes with a not-so-hidden cost.
Someday you're going to be using this in your cars.
What President George Bush signed into law, the Obama administration has since championed. Oil companies required to add billions of gallons of ethanol to their gasoline each year. Most of that is corn, which is distilled into ethanol. But the promise of a greener, cleaner fuel has proven far more damaging to the environment than the government is saying.
There's no question that air quality, water quality is benefiting from this industry. And we're reducing our reliance on foreign oil, as everyone knows.
Despite numerous criticisms from reporters and environmental watchdogs, that soundbite from Secretary of Agriculture Tom Vilsack represented the only positive comment about ethanol included in a video report the Associated Press called "The Secret Dirty Cost of Obama's Green Power Push." And the AP followed up Vilsack with this.
Under President Obama's watch, 5 million acres of land specifically set aside for conservation have been converted to cropland. That's an area the size of Yellowstone, the Everglades, and Yosemite National Park combined.
In a meeting with the editorial staff of the Des Moines Register last week, Vilsack bristled at the mere mention of the AP story, saying it contained a number of errors and inaccuracies. And the secretary insisted that conservation acreage is, in fact, at an all-time high.
Let's talk about the suggestion that we have 5 million fewer acres in conservation than when I became secretary. That is not true. It is true that we have fewer acres in CRP, but we have more acres in CSP, Conservation Stewardship Program, more acres in EQIP, acres in the Wetland Reserve Program, wetlands in the Wildlife Habitat Incentive Program, all the other conservation programs. So I can confidently say that over 500,000 producers are engaged in conservation practices of one form or another on a record number of acres, in excess of 350 million acres. We will add another 24 million acres to that number in this year, so we will be up to 370 million acres or so. So it's inaccurate to suggest that because one program has declined, that all of conservation has declined. It has not.
But the Associated Press wasn't finished.
I can make a lot more money with corn and beans.
That's a dilemma for farmers like Leroy Perkins. The money the government pays to keep his 91 acres unfarmed as part of a conservation program is now less than what he can get for corn.
What's going to happen to the land? It could disappear.
In retrospect this week, Corydon, Iowa farmer Leroy Perkins told the Iowa Renewable Fuels Association that he's a big believer in ethanol, and he's disappointed that what he told AP reporters seemed to be twisted to satisfy an agenda.
Not once was I led to believe they were going to do a wham-bang on ethanol. They mentioned the ethanol. There's two sides to every story, and that ethanol story has got a side, but there's another side to it too.
The evidence is in the ground. In 2012, American farmers planted 15 million more acres of corn farmland than before the boom.
The price of corn at $8 a bushel, a lot of producers decided to take land which had been in CRP out of CRP and put it back into production. Now, corn is now $4.50, $4.20. It'll be interesting to see what happens the next time we have a general sign-up. So it's a factor of the economy.
This color-coded map based on U.S. Department of Agriculture data shows the dramatic conversion in the past 5 years. The darker the area, the higher percent of corn plantation.
It's becoming more common because of how profitable corn is to do corn on corn on corn instead of rotations.
Gullies shaped like fingers show the effect of planting on marginal land. Craig Cox of the Environmental Working Group, normally an Obama ally, calls the ethanol policy an ecological disaster.
So you can imagine, this spring, April, May, there's nothing covering the soil. You get a heavy rainstorm, and the soil erosion and polluted runoff from fields like this is horrendous.
Iowa Secretary of Agriculture Bill Northey disagrees that increased corn acreage automatically results in soil erosion and polluted runoff. Northey, who farms 600 acres in the northwest corner of the Hawkeye State, also criticized the Associated Press reports. And he says farmers in Iowa, the nation's top corn and ethanol-producing state, are going to great lengths to minimize erosion and control runoff from their fields.
Farmers are working hard at it. We've done it for a long time around erosion, and you look at terraces and grass waterways and filter strips that folks have put in. Now we're increasingly looking at water quality and trying to reduce nitrogen and phosphorus as well. Some of those same practices work, but it requires other practices to do some things. We're seeing increased amounts of cover crops that are out there. We're looking at biofilters and nutrient reduction wetlands that are out there as well. So lots of different practices that in some cases farmers weren't using 10 years ago, now are. They're increasingly interested in them, and so we see a lot of effort and engagement around both water quality and erosion reduction.
That runoff, according to Des Moines Waterworks, is ending up in the two rivers that supply 500,000 customers. For the first time, the city had to run huge machines around the clock this summer to filter out the rising levels of harmful nitrates. Scientists say those same pollutants containing nitrogen and phosphorus are traveling all the way down to the mouth of the Mississippi River and beyond, worsening an area known as the dead zone, where marine life can't survive. This year's dead zone stretched more than 5,800 square miles. That's roughly the size of Connecticut.
It's not rocket science to figure out if you plant more acreage in corn, you use more fertilizer, we lose more fertilizer. That means more of it gets into the Gulf of Mexico. We have larger algal blooms and then larger dead zones.
Runoff from farmland, especially in Iowa, has long been blamed for its contribution to the dead zone. And the Associated Press was correct when it reported the Des Moines Water Works operated its nitrate removal facility for a record period this past summer. But RFS proponents dispute the suggestion that increased corn acreage means more fertilizer and more nitrates in the Gulf of Mexico. According to the Renewable Fuels Association, nitrogen use actually declined from the inception of the Renewable Fuels Standard in 2007 through 2010, the most recent year for which Agriculture Department data is available. The RFA maintains the amount of nitrogen required to produce a bushel of corn has fallen steadily over the past 30 years, dropping 43% per bushel since 1980. RFA President Bob Dineen told Market to Market this week he was frustrated by what he called an utter lack of balance in the AP report. Dineen questioned the timing of the AP coverage, with EPA's ethanol blending announcement looming on the horizon, and said he and other proponents will continue to advocate for what he calls America's most successful renewable fuel.
I believe that the Renewable Fuel Standard has been a tremendous success. I believe it is necessary for our nation's economic and energy future, and I, the domestic ethanol industry, and farmers across this country are going to fight to make sure that this important policy remains in place.
On Friday, however, the Obama administration proposed reducing the amount of ethanol in America's fuel supply next year by nearly 3 billion gallons. And when Market to Market asked Dineen what his response would be if that were to happen, he vowed to fight harder than ever before.
We will certainly be commenting to EPA. We'll be encouraging others to let the administration know the mistake that they are pursuing, and hopefully, before this rule is finalized, changes are made that reflect the potential of domestic renewable fuels to continue to grow and evolve, lower consumer costs, lower our dependence on imported oil, and finally address global climate change. If not, if they finalize a rule that rolls back the RFS, the only successful energy policy this nation has in place today, we will challenge it in every venue we possibly can, including the courts.
Next week, Market to Market will examine the impact of the Obama administration's proposal to roll back the RFS and consider its effect on prices from the pit to the pump. For Market to Market, I'm John Nichols.
Next, the Market to Market Report.
Commodity markets were nearly closed Friday afternoon when the Obama administration unveiled plans to roll back the renewable fuel standard by nearly 3 billion gallons next year. And while the Dow posted its 37th record high of the year late this week, grain futures contracts posted modest losses. For the week, December wheat lost 5 cents, while the nearby corn contract also moved about a nickel lower. Soybeans pulled the grain south as the January contract settled with a weekly loss of 16 cents. Nearby meal prices followed suit, giving up nearly $12 per ton. In the softs, cotton rallied this week as the December contract gained 24 cents per hundredweight. In the dairy market, December Class 3 milk gained 4 cents, while the January contract moved 15 cents higher. Over in livestock, December cattle gained $1. Nearby feeders advanced by $1.40, and the December lean hog contract posted a weekly loss of more than $2.22. In the financials, the euro gained 13 basis points against the dollar. Crude oil declined by 76 cents per barrel. COMEX gold advanced by $2.65 per ounce, and the Goldman Sachs Commodity Index gained nearly 5 points to settle at 616.30. Here now to lend us his insight on these and other trends is one of our regular market analysts, Jamie Kawaki. Jamie, welcome back.
Thank you, Mike.
We've talked on the show a lot about corn so far, so let's switch gears. Let's talk about the stock market. Okay. We're still hitting records in the equities. Give us your thoughts on where that could go going forward.
I'm still actually a little bit bullish in a holding pattern yet right now, despite putting in record highs over 10 times this year. Really, the issue with the stock market continuing to push higher is with pension funds, 401ks, is where do you go? You cash out. There's really no other option right now for the large investor, and so I think that's what's keeping it propped up.
Right, they can't all buy farmland.
Right, exactly.
Now, with regard to the equities, is Janet Yellen placement as head of the Fed, is that supportive going forward, do you think?
Yes, it is. She pretty much said this week in her testimony to the banking committee that she is going to continue quantitative easing pretty much as far as the eye can see. That is supportive to the stocks, like you're saying, and also to the metals market. So I think the brakes will be bought in there into year end.
All right, but it hasn't been incredibly supportive to commodities as of yet, as we watch the wheat market continue to fall this week. Tell us a little bit about where that could go here in the near term.
Yeah, you look at a daily chart, it has been really, really ugly. The lower prices have attracted some exports, nothing major to support the market. We're actually at a marketing year low right now, and the market is oversold. So I'm not advising anyone to go ahead and add fresh shorts right now. I would sell March Chicago up around 680. But we got rolled supplies that are very ample right now. Not a lot of wheat is being purchased from us. The winter wheat crop is going in at a fantastic pace and quality, just a beautiful crop so far. So I think you saw rallies in wheat here short term.
For folks with their winter wheat crop in the ground as they look towards harvest next year, forward selling, any price targets out there we should be looking for?
Yeah, 30-cent rallies. I would base it off the March Chicago, same as KC. But there's just no weather issues at all right now to get into a sustained rally to push back above 7. Australia's crop's looking fine. South America's crop's looking fine. And until we get some type of catalyst, I think you continue to sell rallies right now.
Okay, sell rallies amidst a longer-term downtrend?
Right, you let it rally, 680 still, March Chicago, run a stop over 7, but I think you run into some situations, especially down under, usually get some scares. South America, you got to stay short right now.
All right, well now let's take a look back at corn. The big news that did come out today was the EPA sort of codified their stance that they are going to cut the RFS back next year from roughly 18 and change to 15 and change billion gallons. We didn't see much effect on the market. Talk to us about how that could have an impact through the rest of the year, or if it will.
Yeah, it was pretty much priced into the market, maybe moved a penny, going to the close instead of 2 lower or 3 lower to 4 lower, but not a big mover. It was pretty much factored in. I think the timing of it was terrible. We got obviously a large crop, large carryout, and we do it on a year like this, where I think if they wanted to adjust it, we could have done it last year, the year before, when we didn't have a crop, a shorter crop, and supplies were tighter, but it is what it is. The corn market looks very, very weak to me still. I would be selling rallies here up against this week's highs. And I'll also be looking out into the December 14 crop and getting hedged up out in there, up around 490 if somehow we could get a rally up in there. But same here as kind of wheat. There's just not a lot of fresh news. The crop seems to be getting bigger. I look for the December crop report to be bearish as well, more than this month's. And I look for the market kind of hover in the low 4s. I think $4 does hold right now if demand stays where it is currently. Exports were huge again this week, and I look for them to stay supportive. If they do stay up, I think the $4 mark holds in check right now.
Now, with this price of corn, as we're hovering in this low 4s, where does that put us on feed demand? USDA put a big number out there for feed and residual use in their latest report. With $4 corn, does the market think we could hit that number?
I think as of right now, I think it could be, ramped up a little bit from the USDA. Obviously, we're going to have, a smaller hog herd. Cattle supplies are the tightest, since the 50s. So I think maybe a little bit overdone there. But I think everybody's going to try to get as much bought forward priced as they can that are on the end user side.
Okay. Now let's take a look over at soybeans. We did have a nice little rally earlier in the week, settled over 13 for a while, and now we've been selling off. Talk to us about what's happening in the soybean market.
Yeah, we saw a 60-cent rally roughly over the last 2 weeks. We plowed through the 50-day, 100-day, 200-day moving averages, and then saw a nice rally back through the $13 mark. But here late this week, what we saw was basis levels starting to weaken on the soy meal side, the meal side. We also saw margins in China from their crushing margins lighten up as well too, and that spurred some profit taking. We slammed through $13, slammed through the moving averages, and now we're sitting back roughly on the 200-day starting out next week. I think beans are more range-bound right now, $12.75 up to $13.20 for the January contract. Exports were right on the low end of the estimates this week, but China was the big buyer again. But I think today's sell-off was a little bit overdone. It was Friday, a lot of money on the table, and I don't think we'll start off, down 30 next week.
You think we'll probably start open flat?
Flat to maybe a little bit lower, but I think this 200-day does provide a lot of support starting out next week. The key will be demand here as well. But just like corn, I like getting hedged up out into the 14 November contract as well here too. 1190 will be a great spot. I think we're going to see larger acres next year. I think a lot of the fringe acres will be beans, and I think guys need to get hedged up earlier than usual out on these new crop contracts.
Now, is the market anticipating this export demand, even though we saw low end of expectations today? Are they expecting that to continue throughout the marketing year?
I think bean demand will stay very, very good up around the million, area that we need every week to keep the market supported. And I think that will be the big catalyst here yet through the winter.
So as long as we keep seeing those big numbers, we can expect that 12.75, 13 range.
Yeah, exactly.
All right, so all bets are off if those were to fall apart.
Yeah, it's a demand market right now. I think for corn and in beans, the demand disappears. It could get ugly fast. We slammed through last week's lows before the USDA report.
All right. Well, now let's take a look over at the livestock markets. And again, we're still seeing some nice, solid activity in the fat cattle market, up $1 this week, right around 133. Where do you see us going in fat cattle? Are packers paying up on the cash side?
Packer demand right now is pretty weak. But if there is one market that a bull is looking for in ag, I think this is the only one, the cattle market. Supplies are tight, feedlot supplies are tight, imports are down. I think we rally into year end. You can play it two different ways, I think. You can do bull spreads, buy like December, sell April or June against it, sell some puts. But I think the market stays supported, and we retest the contract highs in pretty much all these contracts.
Now, we do have some pretty good carry in the fat cattle markets until the June contract, running out until mid next summer. Now, how is the cash trade tracking? Where are we at seasonally with the cash trade?
132, 133 this week, pretty much steady what the market has expected. Bulls are expecting 135, maybe 137 yet to come this winter. Obviously, a wild blizzard, would help out. But I think just the fundamentals alone are supportive as well too to help out. Look at the placement number. The last 2 months, the bull spreads would indicate that should work as well too. But I think there's more upside here in the cattle.
All right. Now, does that carry on to the feeder market? We're still seeing record high prices for feeder cattle. Do you expect that to stay strong?
I do. I'm a bull here as well here too coming into year end. Supplies, like I said, are the tightest since the 50s. And I think the funds are going to continue to buy into the cattle.
Now, we're currently in the mid 160s. We've been there, a couple of months.
Oh, yeah.
How high can we go? How bullish are you?
I'm thinking 68, 69, that area. Get close to that 170 mark. But I think we're going to try to make one more big push, through the contract highs coming in year end.
Now, advice to producers while we're dealing with all this cash on the table in the cattle market.
Right. I don't want the hedgers to get greedy and, kind of forget about their, production and say, well, we're going to new highs, forget about it. I think you still lock your margins in And if you have to re-own later, some calls or futures do it that way. But I'm still a margin guy on the hedge side and still like locking profits in.
Now, if you're looking to re-own on paper, are there any targets during a downtrend that folks should technically look to re-own at?
80 cents lower from where we closed at today. I think you can start to sell puts, get some puts, $2 to $4 out of the money and start that way. But about 80 cents lower from where we closed at today is some decent support.
Okay. Let's take a look at the hog market. We're still selling off in hogs. We're down another 2 and change this week. Where is this going?
The hog market is getting oversold. I think there is more downside longer term for the nearby contracts, but not exactly right here. I think we need a little bit of a correction back to the upside and then start back down. We've got some seasonal weakness right now. Weights are up. Iowa, Minnesota weights are 8 pounds higher roughly than where they were last year at this time. So that has spurred a lot of this long liquidation. Open interest was down by roughly 22,000 contracts over the last 10 days. Funds are long, they're getting out, but that's just for the nearby contracts where I'm bearish at. You get into the spring, summer, you got this pet virus back out there, so I'm staying away from getting terribly short out into next summer, but these nearbys, I'm still bearish and selling rallies.
But there is the possibility for a correction to the upside?
Right.
How high?
88 for December. I would sell some more or get short if December would pop back up into there. You can also look at bear spreads, opposite what I said in cattle, sell nearby, buy the deferred, playing the pet virus and the ample supplies for the nearbys.
All right. Now, as we take a look on the energy side, crude oil has continued to fall. We're down now to the mid-90s. Where is crude going?
I'm a little bit bearish here. We're in a $93 to $96 range for the January contract. I think we'd be pushing lower if it wasn't for the products, especially RBOB. RBOB supplies on the East Coast are the tightest of the year right now. So I think if it wasn't for that, we'd see more spillover weakness in the crude. But I think you can get down around 90 yet here this winter. Funds are long, and if they decided to pull the plug coming year end, we could drop another $2 to $4 pretty quick.
All right. Thank you so much, Jamie.
Thank you.
Appreciate you being with us. That wraps up this edition of Market to Market. But Jamie and I will continue our discussion and answer some of your questions in our Market Plus segment on our website. You'll also find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account exclusively at the Market to Market website. And be sure to join us next week when we'll examine the Obama administration's plan to reduce the amount of ethanol in the nation's fuel supply. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.